So my name is Fernando Corona, and I am a real estate investor along with my wife. We have a 15-month-old daughter. We've been investing in real estate since 2020, and we had the mentality that we didn't want 20 properties that produced $100 of cash flow. We wanted one property to produce $2,000. And that's what we figured out. From there, we've been sharing that with other people. I recently started hosting these Zoom calls to just pour out that education that we've consumed in the past 2 years. In today's meetup, we're going to have breakout rooms, breakout sessions so that real estate investors or just entrepreneurs or regular people can just talk to each other, see what they're doing with the rising rates, see what they're doing with your passive income streams.
Hi everyone, my name is Isidro Martinez. I currently live in Santa Rosa, California. I also don't have any experience in real estate. Pretty much I'm just trying to get my feet wet, trying to learn from others, connect, network and stuff, and pretty much I'm starting from scratch. So I'm here to learn. I'm here to be a sponge and be able to collect as much experience and knowledge as I can.
Cool.
Awesome. So, like we said, we're new to real estate. We did own a couple of homes right when we got married, and now have just our one primary home. But we're thinking of maybe venturing out and seeing what this is about, and if we can create a better life for ourselves. Because right now we are just stuck in not stuck, but enjoying the corporate life, and maybe there's more to it, and so that's why we're here.
Cool. And then, yeah, Cedro, I'm not sure if you might know a little bit more about what I'm up to in real estate as well. But yeah, I kind of shared what I've been up to. So Cedro, Jim, and I, we all kind of work together right now in other capacities. But okay, so one of the things I asked was the topic. One of these topics. I'm curious, Liz, Pastor, what do you guys think is going to happen? You guys have lived through a recession. I was in college during the recession. Isidro, how old were you, man, when that recession happened?
Oh God, I was probably like 10.
Yeah, I was. I didn't even realize.
Definitely the older group.
I,
I think that's why it's scary. Like, Fernando, we could see you grow in this process, but we're like, oh, this niño. And so it freaks us out, because when we were in the recession, we went out and we had your energy. We were your age, and we said, go, let's get a house. And then we got married and said, let's get another house. And we got them very high. We got them very bad interest, and it killed us. And so we went through a short sale. We went through all this. So now that we're seeing these opportunities, we're scared, right? And
Yeah.
so there's a little more to lose.
What about scared, but more like cautious?
Mm-hmm.
And
Yeah.
really do our due diligence before we invest. And I think investing out of state, which is California, probably for now could be something that we should be doing.
yeah, and can I ask how much cash flow were you guys buffering when you bought that second house? How much cash flow were you trying to get from the difference between the rents?
So we never got. So unfortunately, it was just investing. So we were actually putting in out of pocket. We never got cash flow. We were just investing in the homes, and that's why we short sale, because at one point our mortgages were up to $8,000 for the two homes.
Yeah.
We were barely making enough to pay them.
And so, but you were thinking that you wanted a second house because you weren't thinking that you wanted it for cash flow. You were thinking you wanted it for equity.
We wanted it for cash flow eventually, but
eventually.
But again, we bought at the highest peak before the recession hit, and so we never thought. Yeah, so we never thought that there was going to be necessarily
We
huge issues.
We thought it was just gonna continue, so we were like, oh, I think it's a good opportunity to keep investing, because in a couple of years, both homes are gonna be worth more. But that was not the reality. Especially when from our office we're having layoffs. They have a couple, and then with Andrea we're about the same thing, and we're investing on something that we might not have a job tomorrow, and if we do that, I mean, the bank will be, oh yeah, thank you for paying another year. But after that, you're I don't want to say screwed, but yeah, you're done. You cannot afford it. I'm taking it back, and that's exactly what happened.
And I think because we never saw that cash flow, we're also leery of, is it worth it? We have so many issues with renters. We have so many, we're just,
The consistency.
yeah, it's a little scary.
Yeah, and which is no, super interesting because I read a lot about what happened and why it happened, and how people were kind of put into these arm loans at the time, where it was like very low interest for the first 2 years, and then it would totally balloon. And so yeah, it was pretty wild. So yeah, what about Jim? You're like closer to our age. You're like what, 32 right now, I think.
Yeah, just turned 33 actually.
Nice,
Few
dude.
months back. But
What do you think's gonna happen, man? What's your take?
and honestly, I don't really follow much of the news anymore. For me, if the numbers make sense, that's pretty much my indicator if I should buy or not.
Yeah,
So regardless of how the economy is doing, I think if you have a good strategy on what you're trying to achieve and what that end goal is, um, honestly, it doesn't really take much on when I decide to buy or not. I've been buying properties as the interest rates are going higher and higher. But with that said, I'm noticing that even cash flow is going higher and higher because rents are going up. So
Yeah.
there's still good opportunities even though things are changing a little bit. In the next couple of years, honestly, I do hope there's another downturn so I can scoop a couple properties with less cash. Because
Yeah.
right now, all the properties are really overpriced. So, you just hopefully in the next, I don't know, 2 to 3 years.
State you are in?
I'm in Delaware.
Delaware. Okay.
Yeah, I'm in, just to give you an idea where Delaware is, because a lot of people don't know where it's at. So I'm south of New York. I'm north of Washington D.C. or I'm
The second smallest state. Are you the smallest state or the second smallest state?
I think we are the smallest.
You're smaller than Rhode Island?
Yeah, I think we are the smallest, and I think they have their population is less than us, but yeah, we are less than a million. So
Wow.
we're
Oh,
still,
wow.
even population-wise, we're very small.
So yeah, and Pastor, so yeah, something different that when we started looking into it is just really optimizing your numbers for cash flow in the worst case scenarios. So all the numbers we're running, what I'm going to share with you guys is we're still hitting $1,000 cash flow even with these higher interest rates, even at these higher priced homes. So the way that I see it too, it's like, man, if I'm still hitting $1,000 even at these interest rates, in the next 5 years, I can refinance. Even if you know what I mean, I can refinance, and then that interest rate could drop, and now I'm just super killing it. In terms of
like for like for us when we had our second home, the first home that we had for rent, we were putting about at least 1,000
We were pretty.
in, additional.
wow.
So we were, I mean, I don't want to say negative, but there was no cash flow at all. So
Yeah. No, and that was you guys not necessarily having the education to know how to calculate like for cash flow or even know if it was possible.
no.
Yeah, got it. Cool. Well, thanks for hopping on, guys. Isidro, did you want to share anything, Isidro?
I mean, for me right now, I'm pretty much just saving money, trying to see when is a good opportunity. I do want to eventually invest in real estate, but for me, like as far as experiences and sharing, I haven't had that much.
Yeah. No, I got you. Cool, guys. All right.
Let me give Isidro a quick tip because again, I don't have a lot of experience in real estate. But my first 6 months of trying to become a real estate investor was just running numbers. Become familiar on how to run numbers, how
Right.
to understand your interest rates, or like how the mortgage works, what other expenses can come as an investor. So when you actually buy your first property, there's not a lot of unexpected things that are gonna be thrown your way. So start running numbers, even if you're not buying a house. Just act as if you're buying it. Okay, you buy it for this much, and you can rent it for this much. What is your true net profit at the end of the month? What is that money that is gonna go to your pocket? I did that for about 6 months, honestly, before I actually bought my first. And for me, it was quick. I bought the first, and I bought two more, and then I bought two more, and then I bought two more because
Wow.
I understood my numbers, and it was easier to communicate with the lenders now that you know how to run numbers. You understand what that investment side of things are. You're very educated when you talk to them, so they take you a little more serious. So start practicing because eventually you're gonna be at that stage that you have now going and get lending and put in offers, actual offers that if you get accepted, you're gonna go through the process of buying.
Yeah. No, agreed.
I like that. I appreciate that. Thank you, Jim.
But I'm still learning about that, but that's my goal for this year.
And you said it's called what? Cost what?
They're cost segregation studies that
Cost segregation? I'll have to look
Yeah.
that up. Thanks.
for short-term rentals. Yeah.
Okay.
Nice. What's going on, everybody? You guys talking about cost segs?
Yeah.
Sick. Yeah, for some nice depreciation when your income's a certain amount.
Yeah, I was telling them that's my next goal to get a short-term rental and try to do that for this before the year ends.
Awesome. All right. Don't let me stop you guys. Are you guys almost done with the round robin over here?
Well, Andrea just arrived. Are they next?
So I actually sent Andrea and Jim in here just to join in. But did everybody else go already? Joanna, Lena, Ivan,
Yeah, I
Lorenzo.
think some people just came in here, so.
Yeah.
Yeah, this is Joanna. I wasn't able to go yet. I came in right after, so I did. I think everybody's talking about what they're doing in real estate right now.
Yeah.
Yeah.
Oh, sure. Yeah, I'll go real quick. So right now, I'm also in Los Angeles. I heard some California people here. So hey, everybody. I'm a registered nurse, but right now I house hack a condo in Van Nuys as my primary. I'm currently looking for a short-term rental to arbitrage in Long Beach, as well as doing some wholesaling on the side. The wholesaling part is new to me. I've been an operator with Airbnb in the past, and I had some tenants in Inkwood in the past too. I just no longer have that property. So yeah, that's what I'm doing at the moment. So nice to meet everybody.
Yeah. And your wholesaling, is that in California or where are you wholesaling?
Yeah, I've been just driving for dollars because I've been seeing properties that are in distress. I'm gonna try it here. I've never done it. I'm giving, taking action, making calls and everything. So we'll see how it goes.
Cool. All right. Good luck.
Yeah.
That's awesome. All right. Yeah. Jim and Andrea came from the other breakout room. Do you guys want to give a quick spiel to the new team here?
First, yeah, we're new to everything. We're just here to kind of listen and observe and see if there's anything we can learn and start doing differently. We've done definitely the traditional path of owning a home, working hard, staying in a pretty secure job. But now we're thinking, hey, maybe there's more to it, and so that's why we're here.
Cool. Thanks. Jim?
Hey, what's up, guys? My name is Jim Sanchez. I've been a real estate investor for a little over 2 years. I have 15 doors, long-term rentals. I live here in Delaware, so northeastern part of the country. Again, I'm here to share anything that I can. If there's any questions, anything, reach out.
Yeah. All right.
Did you acquire those properties off market or on MLS?
Most of them came off market through relationships with realtors. So as you invest in real estate and realtors get to know you, if anything, let's say another investor wants to upload 7 properties, right?
What's up, everybody?
Hey,
Is you guys ready to go around?
well, half of us did. The other half are listening in.
Okay. Did Nick went already?
Yeah. Yeah.
Nice. Oscar, you went too? Dope. And Ivan. All right, guys, then I'm going to bring everybody back in. Let's do it. All right. How was Nick? Give me some feedback, man. How was the breakout room?
That was good, man. It was nice having small group and be able to. Obviously, we didn't have too many people actually talk on there, but we had a couple people just exchange information, so it was good.
Cool. Did what was anything stick out from what everybody was sharing, or maybe from what you were sharing?
Biggest thing is people taking action, man. I mean, that's one of the biggest thing. And one of the ladies, she had like 2 boys, young dudes, taking actions. That's the biggest thing. it gives you the motivation to continue on and keep doing this.
Yeah, cool. Lorenzo, I'm at the gym, so don't call on me. Yeah, you got to show your video, man. Show us what workouts you're doing. All right. So who was let's see. Can I call on Lena? Is it Lena or Lena?
It's Lena.
Cool. You wanna go? What did you kind of enjoy about your breakout room, or what stuck out to you?
It was just very informational. People from different backgrounds doing different things. So I'm just listening in from the East Coast.
Cool. All right. What about, I'm gonna pick on Andrea. You told me that you guys were fairly new. What stuck out to you from the breakout room that you're in?
It's just kind of exciting to see a slightly younger generation than us kind of going at it and trying these things, and it's working. And so it's fun to see that, and kind of exciting to maybe be a part of it.
Yeah, no, for sure. All right, I'll leave it out to, does one more person want to volunteer and share kind of what stuck out to them?
Yeah, sure. I'll share. I can't remember her name. I'm trying to find her on the screen, but one of the women in our group shared how in Modesto, I think it's Maria, she has a midterm rental.
You're talking about Liz.
Is it Liz? Okay, yeah, sorry. Liz
Yeah.
has one, and it was a new build. I just never considered going after new builds, and I just like the fact that she took a risk. She's like, hey, it's calculated risk, but if I don't try, then I'll never know if it'll work out. So a little like motivating factor for I guess myself to hear. So that's cool. So thanks.
Yeah, well, just a really cool story. One of our friends who got into a new build during or right before COVID or during COVID, when everything was starting to bubble up, all the real estate prices, he bought at the price as the new build was like starting construction. And then within like half a year, his new build had gained like $100,000 of equity. And you obviously that's not going to be always the case, but pretty crazy story. So yeah, I hear you on that. All right. That's cool. Thanks for coming back, everybody. All right. So I'm going to share just kind of like the strategy that we're going to be doing moving forward. Right now we've helped 6 people get into these properties. We own 2 of them. We're actually in contract to get our 3rd. So I'm going to share the strategy with you guys. And that way, just something else that's out there. And how we're planning on beating this market. It's not going to be easy. And Joanna, you already know if you're out there hustling, being a wholesaler and all these other things. So the good deals are not always going to be easy, and it's not going to be the most conventional way to buy properties or to invest in real estate. But there are ways to really win, especially like in this market that's going to be cooling down, where the demand is obviously going to be going down because interest rates are going up. So let's dive in. All right, so we got a few levers as investors when the market changes. We can obviously change our offer, how we structure an offer. If you really wanted to win a deal, you could do something where you're saying, hey, I'm going in at asking price. If you don't accept my offer in 24 hours, my offer drops by 20 grand. Right. And so doing something creative like that allows people to really start questioning, like, holy crap, should I take this now or try to let something sit for the next however many days, because houses are starting to sit now, and a ton of houses in different cities like Boise, in certain places like small towns, prices are really starting to drop. So getting creative with your offers to get something picked up quickly, is smart. The other thing you can do, and I'm going to get into a little bit more, but start offering 10 or 20K or whatever, 10%, 15% down, just play around with it. Right. And you start to make these offers that are under asking. And as long as you look at some comps, right, and you just want to be under asking wherever you want to be at. And if you put out 10 offers out there, some of them are going to sit. Some of them are going to start to sit for 20 days, 30 days. And that's where you can go back, follow up with the agent and just say, hey, let's start negotiating. So starting with your offer, that's where things are going to you'll be able to have more flexibility, right? It's going to become more of that buyer's market. We're going to go into financing. We're going to go into the different types of exit strategies. Like Liz has her travel medical professionals. That's one exit strategy. And then Jim was talking about earlier, like it goes back to deal analysis. Everything's all about your deal analysis and how you actually analyze a real estate property before you put an offer in. usually putting the offer comes after you have these different strategies in mind, which I'll get into. So we talked about the offer side already. As interest rates rise, start putting in lower offers, let your offer sit, follow up in 20 to 30 days. If they don't get picked up, we're okay with it, because like everybody says, things are going to start going down. So start asking sellers to cover closing costs. So when you do put an offer in and you want some of those closing costs to go towards either buying down your interest rate or just putting cash in the closing costs, so you have less money out of pocket, which is obviously going to bring up your cash ROI. And then we talk about connecting with wholesalers. So for some of you who don't know, that are kind of new, a wholesaler is basically a real estate agent for off-market properties. So a real estate agent has access to the MLS, and they're usually like signing, they're licensed to sell a property. There's supposed to be more of a fiduciary duty. Not to say wholesalers are not fiduciary, but a wholesaler, they're usually just finding somebody who wants to sell their house, who probably can't sell their house on the MLS or doesn't want to pay 6% in real estate fees, or there's some problem usually happening. And so the wholesaler is able to lock the property up, typically at a lower value than what the MLS would be. And then from there, you can actually buy properties from wholesalers. This is just another creative way to start getting properties undervalued. Okay. And then this is getting a little more creative, but doing BRRRRs. So obviously when you estimate your ARV, or after repair value, when you're doing a BRRRR, a BRRRR just means you're buying the property, you're rehabbing it, and then you're refinancing. So one example is you buy a property for $190,000, you put in $50,000 of rehab, and the property is worth $300,000, right? So then all in 190 plus 50, you're at 240 grand. You go and you refinance at the 300 mark, you could pull out a lot of cash, and then be left with technically, let's say, no money in the deal, right? If it's super clean. I don't know if those numbers worked out, but that's just what I'm explaining here. So I'm definitely going to be doing more BRRRRs, maybe shorter term BRRRRs though, because again, I'm concerned about what the valuation is going to be in 2 or 3 months. So this is one strategy that I'm going to deploy. Again, buying properties from wholesalers under market, fixing them up, refinancing them. And I'm already running the deal. When I go to refinance that property, before I even bought the property, I'm analyzing how that property is going to cash flow. So before I even put the offer in, I already know how it's going to cash flow. And then after that, it's making sure that I can buy the property to rehab it the way I need to. This is definitely a little bit more advanced on what I'm talking about here, but it's just one of those levers that you have access to. When it comes to financing, we just bought a property with 10% down. So if you're investing out of state, a property is 200 grand, that's $20,000 down that you need to buy this property. And then obviously you're going to have to do some rehab or things to it. Not typically, but 15% down conventional is another way to purchase an out-of-state property. Most people are used to 20%. We do work with a lender that offers 15% down. And you are going to have PMI with a conventional 15% down. Keep that in mind. Then you have these 30-year or 40-year ARMs. 30-year ARMs, these are adjustable rate mortgages. Let me see, I got people chatting me up. Jose could be, but don't have to be realtors yet. Okay, cool. So an ARM is an adjustable rate mortgage. The way these work is instead of locking you into a high fixed rate, they're going to tell you, hey, we can get you in, let's say it's a 7% fixed rate, we can get you in at 5.5. And then you'll be at 5.5 variable for 5 years. And it's interest only. That's what IO means, by the way. So ARMs, adjustable rate mortgages, 5 to 10 year IOs, interest only, meaning that instead of you paying principal and interest, taxes and insurance, you're only paying the interest and the taxes and insurance. Usually saves a couple $100 off of your mortgage. Depends obviously how expensive your house is. And a 40-year fixed rate, we're actually going to get into a 40-year fixed rate ourselves. What a 40-year fixed rate means is that the first 10 years are interest only loans. The first 10 years are just interest only payments, interest, taxes, and insurance, not principal. So I like that because that gives me more, a couple $100 in cash flow more in those first 10 years. And it allows, even in the first 10 years, for interest rates to drop where I could refinance into a different loan. It allows my property to appreciate over a 10-year cycle, so I could refinance again at a later date. There's just a lot of flexibility with the 40-year fixed rate than the 30 years. So lenders are getting a lot more creative. And I had to get more creative in interviewing like 20 lenders in the past month. So I've just been doing a lot of research on this stuff. All right. Then this is where you get a little bit more creative, depending on your risk profile. I know Jim has done this, or Jim's going to be doing it too. And something that Amy and I are going to be doing, but basically running a HELOC or a rental property line of credit off of your properties to use as your down payment. So home equity line of credit means you have your current property, your home that you live in, and you're sitting on a ton of equity. How do you get access to the cash without refinancing? Because right now refinancing puts you at a super high interest rate. Nobody wants to do that. So you get a home equity line of credit, borrow against the equity in your house to go put as a down payment into other properties that will be cash flowing. We actually just did this strategy with my wife's parents in a pad split, which I'm going to go over in a bit. And just the numbers have to make sense. We're making 20% on the property and we're paying 5% for the loan. So we're still making 15% per year. So when these numbers, you just have to run the numbers for them to make sense. And what was so cool about the property that we just got into is that we ramped up to hitting $1,500 in cash flow per month on this second property in 2 weeks. So it's not like we had to wait. We had to let the property sit to find a tenant for a month or 3 months. Like, no, these things, they got booked super quick. Okay, seller financing and hard money. Seller financing, this is where sellers are going to want to sell, and they're not always going to want to drop their prices a ton. So they face a problem. They don't want to sell at a super small, at a low margin, and they don't want to sell at a super steep price. So when you approach them and you say, hey, listen, I'll buy your house at the price that you want me to buy it at, but I want you to finance it for me. Instead of me going out and getting a conventional loan, I want you to finance it for me. So that's why it's called seller financing, where you say, hey, I'll buy it off of you and at that price that you want, but I'm going to pay you in payments. I'm going to pay you in installments. And then you actually, believe it or not, you can set up a 30-year amortized loan with the seller and then set it up to be, there's different ways to structure it, but that's the point. The point is like where your seller is basically financing for you. So you don't have to take an 8% interest loan, pay your points to even originate the loan, put in 20% down payment. Instead, you work with the seller to just put maybe a 5% or a 10% down payment. You set them up with like a 5% interest loan, and then you work with the seller now to buy the property. So I know for sure if interest rates go up to like 8%, 10%, like I'm probably going to be doing seller financing. I'm really going to be pushing into that. And then you have hard money. Hard money is about just private money lenders or hard money lenders whose money that we can use to purchase properties so that we can rehab them. Like I'm working with a hard money lender who gives me 80% of the purchase price. So if the house costs $200,000 and I get 80% of that, so that means I have to come up with $40,000 as a down payment. But there's rehab costs that they get to give me, and they sponsor 100% of the rehab costs. And let's say the rehab costs are another $50K. That's how we're able to leverage other people's money without having to come up with all the money ourselves. So there's just creative financing techniques that I wanted to share with you all so that you can start to do your research on these, right? If you don't know what ARMs are, DSCR, lines of credit, seller financing, like these are all things more so to open up your awareness to start to educate yourself on these topics. Any questions so far?
You can also, I had a question.
What's up?
Well, real quick, friend,
Did I get cut off or did you? Uh-oh.
Instagram. I can hear you. Can you hear me?
Okay. Yeah, you're good. You're good. Go ahead.
I was just saying your Instagram live got cut off.
Oh yeah. I cut it off. It's cool.
Okay. Okay. But I was gonna say another thing is if you have two people, let's say you don't have the full amount, but you can have a portion of it, and if you can also go in with someone else, right? Partnering up.
Yeah, that's true. Very creative. Yeah, we have on the property we're buying right now, we have 3 partners. And yeah, you're right. There is a lot of creative ways to get into properties.
I was thinking about that myself for my second one. But that's an option. And then I think that's the questions. So with hard money loans, Fern, what are the percentages look like, and when would it make sense to do it versus not do it?
It just depends on how low you can lock up the property. And most of the time, these properties you're locking up are beat up. They need work. So depends on how much meat is on the bones. So if you lock up the property for this low amount of, just easy numbers, $100,000, and you know that when you fix up that property, it's going to be worth $250,000, right? That's right there a perfect time to use hard money. Buy the house at 100, then rehab it, put in another 50 grand, and then refinance it at the true value of 250.
Okay, so hard money is buying the property with cash,
right?
Hard
money can be used when you're buying the property with cash. That's right.
Mm-hmm.
Because that's where because usually these homes that are beat up, they're not going to qualify for your regular conventional financing.
Because the bank doesn't, there's too much risk on the bank's part.
Right. The banks want to loan to homes that they can easily resell in the case of a foreclosure. If they loan you a home that's not at its true value and they lose it, then they have to rehab it, or something has to happen, right? They take on a different risk. Yeah. What's up, Liz? Yeah, come on in, man. Come on in, Liz.
Yeah, I have a question. So you mentioned that you've been calling a lot of lenders, right? Just to compare. When I've bought, I haven't really called, so maybe I'm doing myself a disservice. So you just call, you ask questions about all the different products they have, and then you compare which one's the best for you. You don't necessarily need to have like multiple people like run your credit and give you, estimate. Is that what you do?
Yeah. So usually they don't really have to run your credit to talk to you about your rates and estimate. So I always tell them, don't run my credit. And they don't. Just say, I operate off of an assumption. Look, we're going to assume my credit's a 720 or a 750, right? And I send them a screenshot, of my credit report. They don't have to run your credit. They do that as procedure and policy because nobody ever really tells them not to. Because usually they're the ones that are in control. They're the ones that are guiding you. So they're going to say, hey, the first thing you want to do is run your credit. We just want to make sure what your debt to income ratios are and right? But if you already know what your debt to income ratios are and you already know what your credit is, then you just tell them, okay, let's assume that my debt to income ratios are whatever, 40%, and my credit score is a 720. I can send you screenshots of all that stuff, but let's just roll with those assumptions. Talk to me about X, Y, and Z, right? And then I never have a lender run my credit until I know for sure that they can fund my deal the way that I want them to fund my deal, or else it's a waste of them running my credit. But yeah.
And until you compare like the fees as well, right? Until you see which one is best for you. Okay, awesome. Thank you, Fernando.
Yeah, and especially as you start getting more creative with these DSCR loans or these like 40 years, or you start trying to get HELOCs on your properties, right? Like a lot of the stuff I need to vet other lenders. I just think it's smart to do. On the 15% down conventional, we kind of already, like these two here, we already have the lender we really like working with. When it's a 10% down vacation home loan conventional or 15% down conventional, so I'm trying to find the best lenders. Oh, I did find a cool lender. but I haven't, it just gets harder, you know, in practicality. But I found one where they give you the construction loan and they give you the 30-year loan at the same time. It's pretty cool. So you don't have to pay for hard money. And to my brother's question, the hard money costs are expensive. I mean, you just have to make the numbers work, but you're paying 3 points on the hard money, 2 to 3 points on the hard money, which means 2 to 3% when you borrow the hard money. And then you're also paying the 2 to 3% on the rehab cost that you borrow if you're getting 100% of rehab costs. And then you're paying 10% interest, 8 to 10% interest on all of that loan for however many months it takes you to rehab the property. And then you have to pay another 2 to 3 percentage points when you refinance that whole entire new value of the property. You have to pay another percentage points to refinance into a 30 or 40-year loan. So yeah, learning how to run those numbers effectively, it like I said in the beginning, like it takes work. It's not going to be the easiest thing in the world, but that's how people are going to make it in this new market. You know, getting creative, not buying the most conventional way. Cool. All right. So then we talk about exit strategies. An exit strategy is a way that what you plan to do with the property after you buy it. And there's different levels of exit strategies. So I'm going to share with you guys our level. So the first level is like a midterm rental for us. The first thing we want to do is pad split. Then we want to look into travel medical professionals, renting to them like nurses or doctors. And then we want to look at renting like corporate housing, you know, partnering up with businesses, renting to them. And then there's short-term rentals, which is Airbnb. For me personally, Airbnb was for my wife and I, it was just we don't have any Airbnbs. I'm not like hating on Airbnb. It's just a route that we didn't want to explore because we knew the level of customer service that it requires to service the people who stay on Airbnb, right? These are usually people that are traveling for luxury. They're higher service. I would just leave it at that. And there's a lot more turnover with an STR. So the difference between a midterm rental, which is an MTR, and an STR is an STR. For an STR to be truly profitable in a month, they probably need like 6 to 7 turnovers because they need these people staying in there. So usually you're like 6 to 7, you're flipping, you mean like cleaning your place 6 or 7 times a month. And that means you're at a good occupancy. So that's an Airbnb. With an MTR, which is a midterm rental, you're probably turning a room every 3 to 12 months. So 3 to 6 months, if you're doing like travel, medical, and corporate housing, or even insurance, if you start targeting insurance people, pad split, the reason why I like it so much is a typical stay in pad split 6 to 8 months. And so that means I don't have to turn a room over for 6 to 8 months, which decreases my costs. So that's why it keeps my margins pretty high. Then you have your long-term rental, which is like, I'm always running my numbers so that the long-term rental even works. In the worst case scenario, can my property sustain a long-term rental rate? What's my mortgage on my properties are $1,000 to $1,500. I know that I can rent it out for like $2,200 to $2,500 long-term rental. And then in the worst case scenario, I would maybe sell my property, right? And I try to probably I'd be one of the people who want seller finance. I would seller finance my house or something if I needed to and find a buyer. So that's it. Any questions on exit strategies? No? Right.
Probably not a question. So sorry, Fernanda. Probably not a question, but 1031 is another option.
For financing, I totally didn't put that in there. You're absolutely right, man. Yeah, that is a really good one. 1031, and we're going to be working on that. You're absolutely right. 1031 exchange for some of you who don't know, this just means that you can take your gains from one house that you sell, and without paying taxes on it, there's a process to it. You can roll the gains over into the next house that you buy. That's really the short way of saying it. So usually when you sell a house, there's like a capital gains tax that you have to pay. But when you do a 1031 exchange and you're just rolling it into another property, then you don't have to pay that capital gains tax. Yeah, good point. Good point. All right, this last deal is deal analysis. I'm going to be sharing with you guys a deal analysis spreadsheet that we use for our pad split. And you guys can, if you want to explore what pad split is, then gains, he's referring to equity yet. So like Jim had said before, you got to analyze deals and learn how to analyze deals. Liz, Andrea, when you mentioned how you had bought a property and you weren't sure how to analyze the property for cash flow, there are calculators out there, or Excel sheets, Google Sheets. I have access to a few of them. So if you guys want to reach out to me and tell me, you're looking for an STR calculator, or you're looking for an Airbnb calculator, or a pad split, or a travel nursing calculator, we've explored a lot of these different Google Sheet calculators. So I'm happy to share those with you guys. Different deal analyzers are for different exit strategies, and you get to decide what you like. When you're starting investing in real estate, my goal is to share everything that's out there, and then you guys align yourselves with whatever connects with you. We'll go into the next one. So what has worked for us and what we're doing specifically to tackle these next years. So this is pad split. Pad split is similar to Airbnb. Pad split's just an online platform that brings affordable housing to renters. So specifically in Atlanta for us, but they're in other cities, you have a ton of people who live in Atlanta that make between $7.25 an hour, because that's the minimum wage, to $15 an hour. And at the $14, $15 mark, that's only an average yearly annual salary of $25,000 a year. So a lot of those individuals, they want to live in Metro Atlanta. They want to live by where they work, like by airports, by grocery stores, by Amazon warehouses, but they typically can't get into a solid studio because they need deposit. They need a cash deposit to get in. They don't have a solid credit score yet, so they can't get into certain properties for rent or to buy a property. So there's a lot of reasons why, a lot of problems that we're solving by having our property as a pad split. Something to keep in mind is 12% of revenue goes to pad split, but they do all the marketing. They get all the members on their platform to get our house booked. Like I said, this last house we got 7 bookings. 7 of the 8 rooms were booked in less than 2 weeks, which is wild. And then we do pay 8% to our property manager that's on the floor over there. So this is pad split. Just go to padsplit.com if you want to look into it yourselves. It's super cool. So a few things to know about pad split. They're not a property management company. They're not contractors. They're just a platform, just like Airbnb, just like, let's say, Zillow or something. They're just a platform that people can use. So the way pad split works right now is that our lease, just to be clear, our lease is with pad split. We sign a 1-year lease with pad split, and then pad split signs subleases with the tenants that move in each room. So we're turning a 4-bedroom, 2-bath into an 8-bedroom, 2-bath, and then we're renting by the room. So the minimum stay when somebody first moves in is 30 days to start. So they have to stay for 30 days, and then it goes to a pay by the week model. So we know immediately they're going to be staying for 30 days. We know that if they're there, they're probably going to be staying for 6 to 8 months because that's the average stay. And some people are staying there. We got one guy who's been in one of our rooms. He's paying like $193 a week. So that's close to $800 just for one room, $800 just for one room per month. And he's been there for over a year. So we do have some really, really cool, solid renters. This is their mission: bringing affordable housing to major cities while providing an incentive to homeowners to rent through this model. What kind of incentive to us, right? This is where you can get into the numbers. This is just where they operate. So here's some of the incentives. Pretty cool. Overall, like last month, Amy and I this property that you're looking at here, it's made 2,700 in net cash flow. I'm not going to say that that's possible right now in the current climate, but I definitely will say that you can make $1,000 in cash flow, even with these interest rates. And so I'm going to break down a little bit about like this one specifically, how like our numbers and how it all works. But we bought this for 165 grand 2 years ago. So if you're in Delaware or Florida or New York or California or even Texas or even Arizona, right? Homes for 165 grand that are technically like 2 stories, 2,000 square feet. This is pretty hard to come by in when you're only 20 minutes from the city, right? So this is, the housing market isn't like, yes, it's grown. And like right now, this house is actually so worth probably 250 right now in the past 2 years. So it definitely has appreciated. But in this specific case in 2020, we put 15% down payment and we added $32,000 of work to it. This was to turn it into a pad split. We fully furnished it. You know, we put up the extra walls to build out the extra rooms. We used $45,000 of cash, and then we used $15,000 of 0% credit cards. This is a more advanced strategy to buy a house or to refinance or rehab a house and stuff like that. So we didn't want to use all cash. We leveraged 0% credit, which is basically like a loan, a 0% loan. And this was our projected 25%. So far, we've been over 30%, which is pretty wild. When we look at 30% cash on cash return on investment, $65,000 back. And so that's not a bad deal. I don't know if some of you have been investing in real estate, but usually people are looking for like 8 to 12%. Like people are happy with 8 to 12% returns. Even that might be even high. 12% might be on the high side when you're talking about like a long-term rental. And when you start talking about like 30%, 20 to 30%, then you're dealing with, you know, high cash on cash returns. Yeah, we furnish the whole house. In every room, there is a bed, there is an armoire, there is a lamp, there is a desk, like not a desk, what are those called? A nightstand. All right, so this was property number 1. And then this is Gustavo's house. He's my brother. He's in this call as well. And his was 230. I think his total cash out was 72 grand. And he also went with the 15% down payment. His needed a little more work at 30 grand. So he was a little more cash into the deal, like by 7,000. But even right now, you know, he still was projected to get 20% cash on cash return. So that means that he'll recuperate his 72,000 in 5 years. And his monthly net cash flow right now is like over $1,200. So he's been having a pretty good experience, which has been good. I have other friends that are in it as well. Like I said, this is now my wife and our second property. This is another home. We bought it for 230 grand. We actually just bought this in April, or I think it was April or May. And 230 grand down, 85,000 cash out of pocket. Now I did this for a specific reason. I don't recommend people do this right now, but we knew that with 85K in this property, we were going to be hitting some pretty solid cash flow numbers. And we were leveraging some other money. Like this is an example of leveraging equity at 5% to buy this, to use it as the down payment and the rehab. And now we're making, which in 2 weeks, we're making right now like over $1,500 per month. And our HELOC is like $500. So that's the crazy part, right? That net, we're making $1,500 or more on this property, and we have to pay the HELOC of $500. So we're still in our pocket netting $1,000. The location for this home, like I said, for me, like was still worth paying this 85K because I knew the cash flow that we were going to be able to get from this. All right. Any questions on these types of properties or the model?
Do you put any TVs in the rooms, or is it just a basic bed and nightstand?
So we don't put TVs in the room right now, but I'm not going to lie. In the future, like I see as this gets more saturated and more people jump into pad split across the US, we're going to have to start considering amenities, right? Like a way that's going to separate you from other people is going to be like putting in a TV, putting in a refrigerator in each room, right? Like, we're not doing that yet. We haven't found the need to, but I'm starting to think like that. I'm starting to think like, what do they need? Like what problems do they have, or what else do they need in their room that I can add value? And then at the same time, I can also increase my rents because of it. So not yet. We're not putting TVs. We're not putting fridges in there. Now we're putting like the bare necessities. I do put 2 fridges because it's 8 people packed in one house. So I do put 2 fridges. That's for sure. And then we give them 2 trash cans, like 2 big trash cans. I think those have been like the biggest necessities.
So I have a question, Fernando. So you said 8 people per house.
Right.
And one of the houses was 4 bedrooms, and you split the bedrooms so that each bedroom became 2 bedrooms?
No. So you can see how this is like 2 stories.
Uh-huh.
So typically you have like 3 or 4 beds up at the top and with 1 bathroom. I'm sorry. You have up at the top here, you have 3 beds, 1 bath, and a living room. And then you have a kitchen. So with the top floor, we turn the living room into a bedroom. So now we just turn the top floor into a 4-bed, 1 bath. The bottom floor, oh no, I have my daughter just walked in. Hi, Mama, you want to come say hi? So the bottom floor is like a basement. The bottom floor was originally like no rooms in there. And then we added 4 rooms to the bottom. And so and they already had a bathroom on the bottom, which was, so that's the strategy, you know?
Yeah.
And sometimes there are 3 beds, 3-bed, 2 baths, or 4-bed, 2 baths. Sometimes you'll see 5-bed, 3 baths, 4-bed, 3 baths. So these types of homes are pretty common in Georgia specifically. And we found that these are the types of houses that make perfect pad splits.
And so do you have like a minimum, what are your requirements? You look for certain square footage in certain locations?
Yeah, requirements over 1,800 square feet, all considering top and bottom. The tricky part with the Zillow or with the tax records is that the tax records, for whatever reason, they only count the top floor square footage at times. So if I were to show you this property on Zillow, it would only say 900 square feet. And people would be like, how do you fit 8 rooms and 2 baths in a 900 square foot home? And only because we have experience here, we know that that's not the case. We care more about it saying like basement, split level home than the square footage on paper. Because if it says split level or basement, then I know there's more square footage that's not being counted.
Got it. Okay, thank you.
Hey, Fernando, are there places where maximum occupancies of a single family home just make you not able to buy there?
Maximum occupancy of a single family home. What do you mean?
I believe that there are places, and I just looked it up. I couldn't find any where a single family home can only have a maximum person occupancy. And I don't know.
Yeah. This is totally operating without permits. I got to put that out there. So yeah, in terms of regulations, this is flying under the radar. Somewhat, I will say somewhat in there. I put a little caveat in there because the founder of Pad Split has actually been like really communicating with the mayor and the city of Atlanta. And the city of Atlanta is like, we're solving a huge problem of affordable housing. So regulation hasn't caught up yet. Just like when Airbnb first launched, right? Regulation hadn't caught up to Airbnb. Now we're kind of seeing a ton of regulation on Airbnb. So right now, Pad Split's in this like, people are watching how the market responds, like what's actually going on, what are the negative repercussions of doing this. But in terms of the value it brings to the city, unfortunately, there's very few ways for workers in Atlanta to live by where they work without this strategy. But yeah, we're definitely flying under the radar.
Thanks.
Cool.
I guess with that, are you finding any friction with getting permits for these, outfitting the homes with more bedrooms?
Yeah, that's one of those things we also bypass. We currently are not getting permits. So this is all part of the risk. We do think it's a lower risk just because of the amount of pad splits in existence already. And the contractors that we work with all have like their standard operating procedures to know how to turn a pad split in like 4 weeks. So yeah, we actually don't pull permits. But that's all part of the game.
And how did you find your contractors or your property managers? Is this just all by, you started interviewing people? Like, how did it work? Does the pad split team also recommend certain people, or how does that work?
Yeah, the pad split team actually does. Pad split does recommend contractors, photographers, like there's vetted vendors that they partner with. And so we did take some of those, and then some of them we built out through our network as well, just by, meeting people over there. So like meeting realtors, them connecting us to the different people, us meeting other pad split owners who also were like property managers or something. That's kind of how we built the team. Oh, what's up?
Is it okay if I ask a quick question? So with pad split, since you are subleasing your property for 1 year to them, I guess like what does that contract look like? Or is it just a matter of when you sign up with their platform, that's what you're committing to? On top of that, I also want to know about insurance. Like, do you have your own insurance as well as pad split provides insurance and they're subleasing as well?
Yeah, so pad split has insurance. And then, yeah, we do have our own insurance, and I'm pretty transparent with my insurance guys because my biggest fear was like, if something did happen to the house, I want to make sure it's covered. And like that, there's no reason to dupe my insurance people if something actually happens to the house and they come in and like, oh, this is a non-qualifying house. We're not going to insure anything. So with them, I really vetted a lot of insurance companies, was like very transparent with what we were doing. And yeah, we're good. We're good on that. We pay insurance for one property, $100 a month, insurance for the other property, $150. So the next step for us, we're in contract with new investors. And actually one of my investors might actually still be on here right now. And we bought this from a wholesaler at 190 grand. So the property is worth 270. Okay, so the property is worth 270, but we're buying it at 190 because it needs 75K of work. Like it needs this much in rehab. So how much cash out of pocket are we going to need for this deal? 72,000. But now you can see the house is worth 270 grand. Like the actual, like we're spending 72K. But all the 72,000 is going into the equity of the home. So instead of buying a house at 230, spending 30,000 on top of that to get into a pad split, that 30K that you spend, if you buy a lower priced home, a $230,000 home, add 30K to it, that 30K on top does not go to equity. Typically it did not go to equity. But in this case, when we're buying it this way, all the 72K goes into equity, which is good for us. So this is how the numbers are actually like work out. And even at 6.75% interest, we're still looking at an 18% cash on cash ROI, which is over $1,000 of cash flow. And this is using conservative numbers. So this is what I'm projecting. This is how we're still able to hit $1,000 with high interest rates. Yeah, this is our next project. The next step, we're trying to get to 10 total pad splits by the end of 2022. So this would be our third pad split and trying to get 7 more. So that goes to show you really like how bullish we are. One of my friends, he actually owns like 15 pad splits now. So which is pretty wild. So this isn't, I don't see it going anywhere, me personally, because the model is so strong with who it serves, like affordable housing. I do maybe see some regulation Yeah, he has 15 pad splits in Atlanta. There's more. There's like, I think there's maybe 600 or more than 600. I'd have to look up the numbers. How many actual pad splits exist in Atlanta? The regulation I see coming down is probably, yes, like, okay, you need to pull permits because they need to make sure it's safe. I see like that type of regulation coming. Maybe they say, hey, in a specific street, you can only have so many pad splits. They did already, before, they weren't actually, the tenants were not treated as tenants beforehand. So that regulation has already kind of come up. And that's what I mean, where pad split and the city are kind of working together. Because when pad split first started, the people that were on pad split were considered members. Think about like a gym. So the way that pad split initially launched was like, hey, we're like a gym where we're allowing access on, and we're the landlords of the office space for that gym, right? So sometimes, let's say LA Fitness doesn't buy the entire gym, they'll just lease out the office space and then bring members to work out. That was a similar situation. Pad split wasn't buying the office building, they were leasing the building from us, the landowners or the office building owners, and they were going to bring in their members to live in these homes. What ended up happening was like, it was really easy to get rid of bad tenants. You could just call the police and kick them out of your property, and because they were just trespassing right at that point. The problem was that tenants started wanting more rights. They started saying, no, if I'm living here, like, I want to be treated like a tenant. So there was this back and forth, and that now they're treated as tenants. So if we have to deal with an eviction, then we have to go through that formal eviction process for these tenants, even though they're not like long-term tenants, right? Just a quick story on that too. We did have to deal with an eviction last year. It was during COVID. We had 8 rooms booked. We had to deal with 1 eviction, and we still made $1,800 of cash flow that month, even dealing with an eviction, because you got to think about it. Right now, we basically turned a 1-unit home into 8 units. So if 1 goes down or 2 goes down, we're still profitable. Who would have to deal with the eviction process? Pad split or you owners? Us. Yeah, we would have to deal with the eviction process. But the good news was that we didn't actually, like my wife and I, didn't have to do it because our property manager handled it. So it's been honestly 100% passive after finding the property. There's a lot of work that goes into finding the properties, analyzing the deals, partnering with the contractors, getting the funding together, like all that stuff. There's a lot of upfront work, but this is the best type of work for me. It's the work that you can do upfront and it pays you for the rest of however many years or your life. That's the type of work that personally like drives me. I want to do more of that work. I work early, I work often, and then I chill and I reap rewards.
Does pad split vet you as well?
No, they go and check out your house. They do an inspection. So your rooms have to be, pad split qualified. You need to have like a thermostat, you're working AC, hot water. So they go in there, do a check on your house. So that's probably what they do when they vet us, but it's not like they don't do a personal credit check on us. They don't do anything like that. No.
Okay, sorry, and another real quick one. Did you buy the house or did one of your dozens of businesses buy the house?
So no, my wife bought it. I'm not the breadwinner. My wife is, her W-2 for the first 2 properties, her W-2 allowed us to buy the houses conventional. And if you can buy conventional, like that's a good way of doing it because you're going to get the best rates. And you were able to use the 10% down, which was really nice, going the conventional route. But now that I'm trying to scale to 10 properties, we're going the commercial route, which means, my businesses will be buying the properties. And there's ways to do that. You do have to come in with 20% down. You're going to get hit with a little bit higher interest rates, but it's all doable. Cool. Thanks, Paul. Thanks for asking questions. Do your numbers include the furnishing costs? Yes, my numbers do include furnishing costs. In this total cash outlay, this includes the furnishing. Yeah, and everything. The total cash and all these numbers that I had ran, It includes furnishing. Some risks that you guys should consider, you know, like I already talked about some where you're getting into a pad split without permits. You could have neighbors complaining, you know, and that could cause issues. We've had, I mean, it's just owning a property, right? We've had to deal with a flood on the bottom floor with a pipe busting or something. We had to deal with cutting trees, you know, and that those all incur costs. So it's just the reality of home ownership.
How does it work with it being like, I know you're in California, and do you travel? Does your property manager handle all of that?
Property manager handles all of it. Yep. I'm on a text basis and email basis. I get all the notifications from the platform, but yeah, the property manager they handle all of it. Yeah, it's pretty hands off, right? Once you close on the property, it's pretty hands off.
I do want to add something. Fern?
What's up, Paul? Yeah, go for it.
So when it comes to risk, everything you do, you want to mitigate risk. So you want to do things in the best interest of the members themselves. By the way, I own a pad split property for the guys that don't know me, or girls. And one of the ways you mitigate it is by following what pad split says. Some of the complaints are a lot of trash. So we have people go out there and we have things to regulate trash buildup. So there aren't any complaints. We are mindful of the spaces where people park, so that a lot of people can park on the property, or there is actual spaces to park where there's no issues. So we're constantly working with pad split and the community members, and just to make it so that it works for everyone. Just like Airbnb, as you guys heard, Airbnb has been cracking down on parties, right, happening, or all these other things. So there are things in place to try to make it work for the communities and for everyone within reason. I just wanted to mention that.
Yeah, no, thanks for sharing that, man. You're absolutely right. Okay, I gotta go. I gotta hop off, but I'll leave it open. Anybody else have any other questions before I hop off? Joanna, appreciate all the questions you had. Liz, you too. Thanks, Paul.
Thanks so much. Take care.
You guys all good?
Thank you.
All right, if there's no other questions, this is gonna be posted on YouTube. I didn't get a chance to go over this, but this is just some stuff that we look at and what makes a good pad split. Again, I'm going to share this on YouTube so you guys can rewatch the recording so you can kind of dig into this a little bit more. DM me on Instagram. If you guys, the majority of you kind of know me at It's Fernando Corona on IG. Yeah, thanks for showing up.